Hello, everyone, and welcome back to Capital Chronicles. Today, we're diving into a topic that challenges a widely held belief that being the issuer of the world's reserve currency is an unalloyed privilege. I'm here to argue that, in reality, the USD reserve currency status is more of an exorbitant burden than a privilege. Let's start by setting the stage. For decades, economists and policymakers have talked about the exorbitant privilege of the US dollar. In theory, this status allows the United States to borrow at lower costs, finance deficits with ease, and influence global monetary policy. But what many don't realize is that this so-called privilege comes with hidden, long-term costs that we simply can't ignore. First, consider the very nature of being the world's reserve currency. Countries across the globe hold large amounts of dollars in their foreign exchange reserves. They do this because the dollar is seen as a safe, liquid asset. While this may seem like a vote of confidence in the U.S. economy, it also means that the United States must supply the world with dollars. And to do that, the U.S. often runs persistent trade and fiscal deficits, a situation famously known as the Triffin Dilemma. The Triffin Dilemma, named after economist Robert Triffin, highlights a fundamental conflict. If you're the issuer of the world's reserve currency, you have to run deficits to provide enough liquidity to the global economy. But running these deficits over the long term can lead to unsustainable debt levels and economic instability. Essentially, the U.S. is caught between two incompatible goals: maintaining global liquidity and keeping its own economy healthy. Now, let's break down why this is such a burden. First, consider the domestic implications. In order to supply dollars, the U.S. government must finance its current account deficits, often by borrowing heavily. This continuous borrowing can lead to an ever-growing national debt, which in turn puts pressure on fiscal policy. Instead of channeling resources into domestic priorities like infrastructure, education, or healthcare, a significant portion of the budget must be devoted to servicing this debt. Moreover, these deficits aren't just numbers on paper. They have real consequences for economic stability. When you're reliant on external demand for your currency, you become vulnerable to shifts in global confidence. A sudden loss of trust, perhaps triggered by political instability or poor economic management, can lead to rapid capital flight, exchange rate volatility, and financial crises. Essentially, the very mechanism that allows the U.S. to benefit from the dollar's reserve status also sows the seeds for future economic instability. Another often overlooked burden is the impact on monetary policy. The Federal Reserve's decisions are not made in a vacuum. Because the dollar is used globally, every rate cut, every policy shift sends ripples across the world's economies. While this global influence might sound beneficial, it can actually limit the Fed's flexibility. The central bank must constantly balance domestic economic conditions with the potential international repercussions of its decisions. This balancing act can force policymakers to adopt strategies that aren't necessarily optimal for the U.S. economy. Let's take a closer look at how this works in practice. Imagine a scenario where domestic inflation starts to rise. Normally, the Fed might raise interest rates to cool the economy. However, a rate hike in the United States can tighten global financial conditions because many countries hold dollars or are tied to the dollar through trade and investment relationships. This means that a decision meant to stabilize the U.S. economy might inadvertently trigger financial stress abroad, which, in a highly interconnected world, could circle back and impact the U.S. economy in unexpected ways. This global interconnectedness adds another layer of risk. When the U.S. government and the Federal Reserve are seen as guarantors of global financial stability, they become magnets for speculative capital flows. While these flows can provide short-term liquidity, they can also lead to sudden reversals. During times of economic uncertainty, investors might rapidly pull their money out of U.S. assets, leading to sharp movements in interest rates and exchange rates. Such volatility makes long-term economic planning and policymaking far more challenging. Another burden comes from the pressure to maintain global confidence in the dollar. The U.S. must constantly project fiscal and monetary stability, even if that means making politically unpopular decisions. This pressure can limit policy options during economic downturns. For instance, If domestic policies need to focus on social welfare or long-term investments, but are instead forced to address short-term fiscal imbalances, the broader health of the economy may suffer. In other words, the need to uphold the dollar's reputation on the world stage can lead to domestic policy compromises that hinder sustainable growth. Let's also talk about international dynamics. The reliance on the US dollar means that the United States holds a unique and sometimes precarious position in global finance. Countries that depend heavily on the dollar are not just passive holders, they actively influence international policy. This can lead to diplomatic pressures and conflicts, where foreign governments might push the US to adopt policies that favor global stability over domestic priorities. In effect, the US is sometimes forced into an international role that comes with its own set of challenges and responsibilities, which many view as a burden rather than a straightforward privilege. Furthermore, this arrangement creates a kind of dependency. The world's financial system has grown accustomed to the convenience and safety of the US dollar. As a result, any shifts in US economic policy or signs of fiscal distress can have outsized global impacts. This dependency means that the US is always under the microscope, with its policy decisions having immediate and sometimes volatile consequences for global markets. The burden of being the de facto global standard in finance is heavy. It requires constant vigilance, accountability, and a level of fiscal discipline that is difficult to sustain over the long term. In summary, while the USD's role as the world's reserve currency has provided certain short-term advantages, like cheap borrowing and international clout, it also comes with significant long-term costs. The necessity to run persistent deficits, the pressure on monetary policy, the risk of financial instability, and the geopolitical strains all contribute to what many see as an exorbitant burden. The privileges of today could very well be the liabilities of tomorrow. So, what's the takeaway? It's important to look beyond the surface-level benefits and critically assess the hidden costs. The US dollar's global dominance is a complex issue, interwoven with economic, political, and social challenges. While it may seem like a boon on paper, the real-world implications suggest that maintaining this status might be more of a heavy weight than a golden ticket. As we move forward, it's essential for policymakers and citizens alike to engage in open discussions about sustainable fiscal practices and the long-term viability of our current monetary system. Whether the US can successfully manage the burdens of its reserve currency status, or if it will eventually have to adjust to a changing global landscape, remains one of the most critical questions of our time. Thank you for watching. If you found this analysis thought-provoking, please hit the like button, subscribe for more deep dives into global economic issues, and leave your comments below. What do you think? Is the dollar's reserve status more a burden than a privilege? I'd love to hear your thoughts. Until next time, stay informed, stay critical, and keep questioning the narratives that shape our world. See you in the next video.